time, and I work six weeks on, 6 weeks off on the yachts, and it's brought me to a lot of places in the world that may never have experienced. The same thing like multifamily. It's just another thing that I didn't even know it existed for the most part, even though I worked on the yachts.
Welcome to Real Estate Hustlers Podcast. I'm your host, Josh Appleman, founder and CEO of Appleman Capital. Today we're joined with Scott Kidd. Scott is a licensed U.S. CG master with 25 plus years in maritime. He's also a multifamily real estate investor, runs Yacht Real Estate Investors Meetup in Florida. Scott, we appreciate you coming on the show today. If you could let the listeners know a little bit more about yourself.
Sure. Thank you very much for having me. I've been a yacht captain for the last 20 plus years, been on yachts for 25 years, been doing multifamily real estate for about 4 to 5 years now. Started off doing some single family stuff like a lot of people, and then found out about multifamily syndications, and that kind of was my light bulb moment. And last year and a half or so, I've been focusing on raising capital and investor relations.
How's the capital raising been going for you?
It's been going okay. I guess a few years ago it was a lot easier. I guess a lot of people are a little apprehensive, especially retail investors. But I'm finding that larger equity groups and funds and fund of funds have a lot of money sitting on the sidelines and are starting to move now.
Yeah, yep. There's definitely a ton of dry powder just sitting there waiting for the deals to come. There's a lot of opportunities coming online. You just gotta keep your head to the ground and keep the relationships going. Where's your portfolio predominantly located?
We have North Carolina, Florida, and we've been looking in Texas. And right now we're heavily focusing on Columbus, Ohio, just because I see a lot of similarities to where I went to college in Austin and University of Texas. There's a lot of tech moving in. It's very affordable. There's a lot of tech jobs coming in, and it's 20% of income is the rent, so it's very affordable. And just with so much money pouring into there, I see it becoming the same thing. Austin is a lot of people I know that live there now, they've moved out to the outskirts because inside the city has gotten very expensive over the last 25 years.
Yeah, we're out of Cincinnati, Ohio, and Columbus is probably about an hour and 45 minutes from us. Been up there a few times checking properties out, and yeah, the Midwest is it's steady Betty as far as population growth, job growth. But I mean, its past performance can equal future results because it's just steady. There's no erratic upswings or downswings. It's kind of, and the cost of living. I mean, you can have a lot more house here than you would in different parts where it's just very bloated cost. Like $1 million house in California compared to $1 million house here is just truly night and day.
Very much so.
Yeah,
$1 million house is the median price point in California. $1 million house in Ohio could be a McMansion for sure.
But that goes back to what you were just alluding to, the cost of living and being able to stretch your dollar out and get more for it. So tell us, like, what do you look for in projects? What's your buy box? What entices you to go out there and raise capital, and you're confident that the capital you are receiving is gonna make more for your investors?
Well, like you said, steady Betty here, and in the Midwest and Columbus especially, we're very bullish on that just because of the affordability, and it's been very steady and all the influx there. The buy box is mainly a light value add, mostly stabilized 2,000 plus assets that are B plus. That don't need a lot of work, just due to the last few years. I've gone through some larger value add projects that were a lot tougher, and I'm seeing a lot of people struggle now, especially after COVID, with labor shortages and supply shortages, and then just now with the financial markets, a lot of them have tightened up with a lot of things. You have to kind of move more into the private equity side, and those are usually moving towards most of the institutional grade assets. So we're kind of focusing more on the core plus stuff that we know that investors want, and they know over the long term that's what they're very stable assets, and you might get better returns with the larger value add projects, but there's a lot more moving parts and there's a lot more risk. But with that more risk, you do get a lot more reward. But we're focusing on mostly steady, stable stuff.
Yeah, and a lot of the value add, older vintage, you need to do complete gut remodels, all new cabinetry, or refacing the
Yeah,
cabinetry, new flooring, carpet, paint, baseboard, electrical, even electrical outlets, light
yeah,
fixtures, plumbing. That's and that's to maximize the value to bring it just
yeah,
up to the standard. But there's groups that were also buying it based on a performa. So the property
yeah,
down the road is a newer vintage. It traded for X, and some
yeah,
of these groups were buying it for X. That's their basis. So now they still have to do all the work. And then once all the
yeah,
work is done, they've already given away all of their upside.
yeah.
There's,
Most definitely. I mean, and you also have all the benefits of having something that's already stabilized, it's cash flowing already. You don't have the big gap of potential that in a year or two you're going to make those rents, and with the way things are going, if you do have a lot of layoffs and stuff, you may not be able to make those rent bumps.
yeah, I think it's tougher now, like you had mentioned, as far as getting capital because the coupon clipping properties, the returns, you're up against money market accounts where there's no risk adjusted. It's risk
Hmm.
adjusted returns. Multifamily, there is risk, of course. Money market account, there's a risk of course, the bank failing, but it should be FDIC insured to some
Yeah.
degree. What have you seen as far as the movement of cash going from different vehicles such as that?
I see, I see some people holding back because they can get the 5% money market, but I focus on letting them know that next year it won't be there, but if you come into some of these projects now, you'll be making that same, you know, on the one property we're doing a 8% pref, and then the IRR is going to be much higher, and the IRR will be what it's going to be, but you'll be making a steady 8% for the next 5 years, whereas the money market and stuff will be 5%, probably 4% next year, maybe three. We're not sure, but I'm seeing other people seeing a lot of traction with people talking about oil and gas and all these other things. But my old adage is if I don't understand it or don't know about it, I just don't do it because that's I get there's a big learning curve for me with those types of things. With multifamily, I've been doing it for a while, so I understand that more, and that's more me focusing on aligning with what their interests are, and because it's always about the investor anyway. It's got to be up to their tolerance.
Yeah, and money market accounts, they don't offer depreciation last time I checked.
No,
So it's
no, they,
there's that.
they do have an inflation adjusted returns that 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 go down every year.
Yeah. Yeah, no, you can go out, see it, touch it, feel it. It's real estate. It's
Yeah.
there, um, for sure. What do you look for in an operator? Yeah, you're coming in alongside within the GP general partnership, help raise capital. What about the jockey on the horse, the operator? What do you look for?
Generally, the one that I'm solely involved with now is a guy that I invested with as an LP 3-4 years ago now, and I was part of his mastermind. And everybody that's GP on this particular team is all we're part of the mastermind group, so we're all real comfortable with each other, and we know the deals that. The main thing that I look for is the experience and just the I would say the compatibility, like-minded, you know, mindsets where we're, aligned interests, because everybody's not in the same place in life at the same time. and people's interests change, but I mostly focus on, the level of communication, which the communication is always, he's always helped me learn more and more, which there's always more to learn. So I always like that. That's what I look for, is like open communication and, the track record that's there. In Columbus, they have done about seven properties there and done a couple of them full cycle. That's important. Track record in the area is very important as well. Experience in the area, their contacts. They have a certain amount of great relationships in the area. That's really important as well. Um,
There's a one broker in Columbus that you have to know the broker.
yeah, yeah.
Like
I'm,
dominates and owns the market.
he's the guy we're dealing with, and he's the guy
Yeah,
they've dealt with for years. And I don't want to share the name, but I'm sure we're talking about the same guy.
yeah. There's only one.
There's only one, yeah, because he does it all.
Yeah,
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 his
but
his
they do
group's
a
pretty
great.
strong.
Yeah, they're good. I mean, they're marketing and they've got
Yeah,
a really good reach. I mean, and they play matchmaker too. They find the property.
yeah,
They know which buyers are good for the properties.
yeah.
There's
No,
every
they're no doubt about it. They're top notch. They're the number one for a reason.
yeah.
You know.
Yeah, and
Yeah,
it's incredible. I mean, it just shows the drive and determination of one individual, and to get to that
yeah,
caliber. I mean, because Columbus is a huge city in itself,
yeah,
and it's growing even bigger. I mean, it's bringing in a lot of economic drivers, which is great. There's still some pockets in Columbus that'll get you in trouble.
yeah,
Property looks incredible until you take a drive in the neighborhood.
yeah,
Those are the traps. But
yeah, for
um,
sure. Yeah, I had a friend of mine a long time ago, even when I was buying my first house. He said, "Hey, before you buy the house or before you go put in the offer, go drive by there at nighttime,
yeah,
and then drive by there during the week." And then, sure enough, I drove by this one house I was looking at during the week, and there were just people kind of hanging around on a Tuesday, and I
yeah.
was like, "Yeah, that's probably not good."
Yeah, up to no good.
Yeah,
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 no.
probably not
We
good.
went to one and it was completely renovated. Everything looked great. And then you get there, there's trash in front. And there's just literally trash and mattresses everywhere. I mean, it's just those.
Oh no.
It's just what it is. But that's where you do
Yeah,
your diligence and you drive. You
yeah.
make the drive no matter what. There's
Yeah,
nothing
one
more telling.
one other thing that neglected to mention was, boots on the ground and stuff like
Yeah,
that. The operator's gotta have somebody in the area that's, able to drive by and take a look and meet with people, and that's one thing that's very important. The hands-on experience, or at least someone to go put another set of eyes on it, is a big deal.
yeah. Are you all using third-party property management or vertically integrated?
Not vertically integrated as yet, but we are using a company that's in the area, local third party management, and we do have a person on the team that lives right there in Columbus that's got some real estate experience that's working with the guys and the team in the area.
Yeah, that helps keep making sure the expectations are met and there's no mattresses,
Yeah,
nasty
there's no
dumpsters.
mattresses, and there's no, you can go by and make sure all the timelines are kept and stuff like that, and that's really important if you want to hit all those targets for the investors and hit the targets for the residents, because it's number one, if the residents don't like being there and they're not happy there, you really don't have a viable business plan.
No, and it is a business. There's
Yeah,
I mean, just uh, the people that are passive are limited partners. If they want mailbox money, they come on as a limited partner and let the GP team do the work. I had had a conversation with somebody, I want to say a couple weeks ago, and he's the jockey on a horse, and he said he got into real estate just for to be passive, but he's bringing investors on with him. And I'm thinking, you don't, you can't be passive. You just, I mean,
no,
it's a disservice to your investors. You have to push
mhm,
rents. You have to maximize the property value,
mhm.
and that mindset. I mean, if you've got it, you need to come on as an LP and let the guys that are pushing the property and really getting into the work, let them
Yeah,
managed
let
at
them
the end of
get
the day.
dirty. Yeah,
Yeah,
let them
yeah, because
grind, grind hard,
it's like any other business. The grass is not greener on the other side. There's still
No.
people issues to deal with. There's still meeting
Yeah.
targets, deadlines. There's cost. Just like renovations, if you're not maximizing the procurement of materials, then you're still just you're giving away what could be going right back. And the more you save, the more you keep. So you could be giving it right back to the
Yeah.
investors. Are you is your all's property management managing the renovations as well? The
There's
retrofits.
on this one, there's not too much renovations there. It's mostly just, it's a 2015 asset. This
Nice.
particular one we're working on. So the roofs are good. All it really mostly needs is some paint, some press up, and some cleanup as the units turn. A little bit of updating. We don't have too much allocated. I think it's 3,500, 4,000 per unit for turnover. It's mostly paint and fixtures. We're going to do uh, some renovations. Probably do some upgrades to some countertops and stuff like that. Just to kind of see where it goes. That kind of stuff. See if maybe we'll test a few units and see if we can get the rents a little bit higher. But if they don't bring much higher, then we probably won't do that. We'll just do the most, the cleanup, make them nice and really livable for the tenants and stuff. Keep on par with what's in the area.
I think that's it because it's not necessarily pushing rents higher. It's what is making the unit more leasable and keeping the tenants
Hmm.
there for longer. Because if there's granite countertops next door, somewhat same vintage, maybe not, maybe, but you've got granite to offer and they don't. That might lure in a
Yeah,
tenant that would have went the other direction.
yeah, and you
Also,
might
of
get
course,
another. Go ahead.
amenities, the experience. A lot of
Hmm.
it is going to be use and just move on. Meaning it's an experience type of market where amenities come into play with
Yeah.
with a lot of different things. So um,
Most definitely. It's really important that you make sure you know what's going on in the area. That if no one has granite countertops, there might be a reason why. If you put them, it may not make a difference. It might not. It might demand a little more money, but it might not be worth the squeeze of the juice. For that particular area.
if it gets you out of hovering in the low 90s and it pushes your occupancy up a little higher, it just what do the numbers support?
Yeah,
It could
most
go either
definitely.
way. Um,
Yeah, you just have to test, and keep testing, and then
yeah,
keep adjusting. And nothing is set in stone. What works right now, a year from now may not.
yeah.
Things as we saw through COVID and all these interest rate hikes, things can change pretty rapidly.
Yeah, yeah. You just got to find the alpha. That's what entrepreneurs
Yeah,
do. They look for what is the alpha here? How can I improve it? What can we do better and different? I mean, if everyone just follows the herd, then you're all going. You're
yeah,
going to end up the same result. So it's what can we do to make this property unique, the experience different, and find that alpha. Find out how we can maximize different things. Um, tell us about the being a captain of a ship. Tell us about how does one go from being a captain to multifamily, and are you still a captain?
yes, I am, and I work 6 weeks on, 6 weeks off on the yacht, and it's brought me to a lot of places in the world that may never have experienced. The same thing like multifamily. It's just another thing that I didn't even know it existed. For the most part, even though I worked on the yachts as with probably one of the larger developers in the DC area, but I didn't know this is how all this stuff worked. But you don't know what you don't know. But I work 6 weeks on, 6 weeks off. But real estate, since I'm somewhat of a junkie, I work just about every day on real estate, just because I mean I love doing it. I love meeting people and learning more about all the options there are available. I mean, there's so much opportunity, and being on the yachts, I've got a chance to meet a lot of really high net worth individuals, and a lot of times, if you ask them, how they made it or what they do, they'll tell you all about it, just because they like sharing their stories. At least the ones that are most genuine and stuff, and it's
Yeah,
it's a fairly unique business where you get to work right with these people that most people don't have access to.
Have you ever gotten caught in any major storms out there with your guests?
Not with the guests per se, but with when we're delivering or repositioning the boat. We've when we're on a longer passage, anything more than 3 days. Sometimes you get caught out some storms and stuff. Yeah, it's happened. I've actually been through hurricanes and stuff like that. It's not fun. I mean, we've been anchored off in the Chesapeake, and it was Hurricane Isabel. I was
Wow.
actually with the boss at the time. He was on the boat. He came down to help out. He was quite a good seaman, so he was with us, myself, him, and the pilot. It was a rough night, but we made it through.
Like what does that look like? The captain or the owner comes down. How big's the boat?
This one was 80 feet, and
Wow,
it wasn't
that's good
bad. But
size.
the boat I'm on now is 50 meters, so it's 164 feet. But the
Okay.
boats on the yachts go, now they're 5, 6, 700 feet. Granted, those are a few of those, but I would say 150 or so, 160 is probably the average nowadays. There's some really large ones, but it's it's a unique business because when you get into the larger vessels like that, the I would probably venture to say that they're not affected by the economy as much as they probably are a larger part of the economy. These people that have these larger vessels like that, because it's someone that can afford a 200, 300 foot yacht like that as a toy. Yeah, they have to have a certain next level of net worth because they're not just the 1%, they're probably the 0.1%.
Yeah, they've got a machine that is built to just kick off cash flow.
Yeah, yeah, and they probably have generations of it, or they just they're in the B club, the billions, you know.
Yeah, that's wild. And like you said, I mean, there's no better place really to raise capital because you're in the epicenter of money.
Yeah. Well, it's can be good. It does. Yachts bring a certain level of people like to know about them, talk about them, but it's the same thing. Like to develop that level of that type of relationship with those people, it takes a really long time,
Yeah,
and for the most part, they know me for running their yachts, so they would give me, you know, not very easily, but if we're doing a refit or something like that, or, a couple $1 million or something like that, but to get them to understand that I'm in real estate, that takes some time,
yeah.
because they know, because I have the 20 plus years experience. Now, when I have 20 plus years experience in real estate, that'll probably be an easier jump.
Maybe there will be a offering memorandum on the table when they board ship. Oh, what's this?
Yeah, what's this? And you're fired.
Yeah, didn't mean to leave that behind.
Yeah. Whoops.
So what made you want to get into real estate from like what was the I guess the change?
Well, we as my family got bigger, we bought our first house, and then we got a second house. As the family got bigger, got into single family rentals and stuff like that. And then I was actually at the hanging out with a couple friends on the beach, and one of the friends told me that he had bought and sold a 46 unit in Houston, Texas, and he made quite a large amount of money within a couple of years. And I asked him, I said, "Well, you can do that?" And he said, "Yeah, you can do it. I did it. It's not, myself and my brother did that." And he said he told me all how he did it. And he didn't sound any it sounded more complicated actually than all the work I was doing dealing with the rental property and everything else. And he so then that was kind of my light bulb moment that I could do that and venture into that. And I knew I always saw it as more of a stable asset. I just didn't know it was that accessible. And then I just did a lot of research and went through a lot of different things, chased a lot of shiny objects, mobile home parks, RV parks, storage.
Yeah.
But I kept coming back to multifamily just because, it's a unique asset class where it's actually no other commercial asset has some backing from the U.S. government and stuff, where you have um, you know debt products that are specifically designed for multifamily, and that you don't get in any of the other asset classes in commercial real estate because people have to live somewhere. It's kind of a need.
Yeah, yeah, and all roads lead back to real estate. Different businesses, laundromat. If you compare a
Yeah,
laundromat to just even a bowling alley, just if you look at the expenses and then you find out which ones are more intense, meaning that you have to be there to push these things and push, like
yeah,
all roads lead back to real estate. It's just less
yeah.
complicated.
It is, and and I love that movie about the McDonald's
Yeah.
model. We're not in the burger business; we're in the real estate business. And
I just learned that he even one upped himself. Instead of him having like a set lease on the franchise on the real estate for the franchisee, like say $3,000 a month, he would base the lease amount based on gross sales. So the
yeah,
lease rate would even increase too.
yeah, it was what do they call it? A a revenue generate model, where you get a
Yeah,
percentage of that. So they were incentivized to one, keep the proper keep the roof on by paying the rent and paying the franchise
incredible.
fee based on the revenue. So it's he was love him or hate him, he definitely took McDonald's the to where it is today.
Yeah,
Sure.
well, and became a kind of a model of how to base other ventures off of, as far as keep holding the real estate, leasing it back to the owner operator. I mean,
Yeah.
that's a huge win. Um, Very cool. If somebody wants to get a hold of you, Scott, reach out, learn more about you, and see what kind of deals you have. How can they get a hold of you?
It's pretty easy. It's investwithscottkid.com. You can find everything that you need to know about me there. Um,
Awesome.
yeah.
Very good. I appreciate your time today. Look forward to following you, and certainly talk soon. Thank you.
Well, thanks a lot for having me. I appreciate